Good morning, this is Ken Long from Tortoise Capital Management with some regression line crossover case studies traded July 9th, 2013. Our opening trade was in XIV, that's the inverse VIX ETF. We're looking at 3-minute charts. This is the gap up opening. Dark blue is the 30-period regression line plus or minus 1, the river. Light blue is 30-period regression line plus or minus 2, the floodplain. Purple line is the VWAP volume weighted average price. Red line is the 30-period simple moving average, or the midpoint of the river. Dark green is the 90-period regression line. Black line is the 30-period regression line. Blue line is the 10-period regression line. This brown line is a 200-period linear regression of the VWAP, which I'm treating as the very long-term price target, and the direction is the long-term trend. So we had a gap up and spike, and then a decay back to the Bollinger Band mean, which is what you would expect. We have a long side bias on the inverse volatility trade here because of the risk index. We've been expecting volatility to dry up, so when we get a spike up, a pullback, and then support at the Bollinger Band mean inside the river, that meets that template. It finds support above the previous close, so that's good. We got the little double bottom here, and so I see a low, a higher low, a higher low, a higher low. I take this entry here at 52.80 with a 20-cent stop just below the swing low of the ribbon, which is the 2-period Bollinger Band, which I'm treating as the real price. So that's my risk, is 20 cents. I'm looking at price targets of just outside the river to the swing high, and then I'm looking at the far side of the floodplain as potential targets. The way that one actually worked out was it got up to the top of the river, started to reverse. I exited at 53 even to get started well in the morning for a 1-hour gain. It immediately found support at the VWAP and reversed, so I re-entered at 53.05, again with a 20-cent stop. In this case, that would put it just below the Bollinger Band mean. That is moving up sharply, gets out to the floodplain, starts to decay, pulls back to into the river. I decided to take that one at 53.40 for 1.5R. Now I'm stalking a re-entry, comes back, finds support as you might expect at the Bollinger Band mean, makes a low, a higher low, the next higher low, and takes out the previous candle's high. I'm back in at 53.35 with a 20-cent stop. Puts us down around just below this 200-period regression near the bottom of the river. Takes off. I've got a meeting to go to, and so I take the exit as it starts to decay just outside the river at 53.50 for 0.7R. So that's about 3.2R on the morning trade in volatility in a measured way. Later, after my meeting, I come back. I see that it had pulled back and found support at the Bollinger Band mean. And as it's leaving the floodplain, I decide, what the heck, let's go for it. It made a new high of the day late in the day, late at lunch. I'm expecting another leg up, so we entered it here at 53.60 with a 20-cent stop, which would be right at the Bollinger Band mean. It takes off, has a nice spike up, pulls back, finds support at the edge of the floodplain, and starts to take off again. So I put a second position in. I normally wait for 2R in hand plus momentum, but my feeling is this could be a runaway, and so I want to front run that a little bit. And then I thought better of that, and I said, that's too much after a nice move up already, so let me throttle back. I cash one at 53.85, so that gives me a little over an R on that one. The second position, I keep a 0.1. I'm using a 0.1 stop, which is just underneath the river, so if it fails, I'm going to get out of this quick. And I've got another meeting to go to, so I use a 0.1 trailing stop, and that one moves up to 53.95, pulls back to 53.85 pretty quickly, or 53.80, and so this ends up scratching shortly thereafter. Not really satisfied with that. It was a venture on a runaway, what I thought could be a runaway train, and so I was very quick to get out of that one. But it does come in with an extra R, so that's about 4R during the course of the day on a trending upward move in the inverse volatility ETF. So that's Ken Long from Tortoise Capital with trades of the day for July 9th, 2013. Thanks for your kind attention. Keep your risk measured and your powder dry.